Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Friday, the 13th of March. Hopefully, we'll have good luck today. Okay, so overnight, not a huge amount of sort of change. The basic themes remain in place. We have elevated energy costs. We seem to have a sort of a stalemate, non-resolution with the Iran situation, ongoing attacks. Neither the US nor Israel nor Iran are budging. And we also have yields very, very elevated, and which is causing equities to remain under pressure, although there's a huge sort of underperformance now of emerging markets and Europe versus the US, which is perceived to be more insulated because obviously less insulated, more insulated from higher energy costs. So Europe is more exposed. And as the US dollar is getting very, very strong, that's putting emerging markets under pressure. So what we're starting to see here is a sort of a constant pattern. And who knows, going into the weekend, is this another sort of a risk event? It's difficult to see markets sort of relaxing or breathing out, so to speak, on a Friday afternoon. And what we also get today, we get some information about the jolts. In the US, we get the job openings and labor turnover. So we'll get some more sort of perspective on the US labor market. And we also get the core PCE inflation. And we know that the markets are very concerned about the elevated energy costs, which is creating inflationary pressures, and that's feeding into short-term rates going much, much higher, and expectations for central banks to be much, much lower. So first of all, let's just have a look at that and have a look at this, that what I was saying about the central banks here. Yes, if I have that. Yeah, so just interesting, and this is courtesy of Bob Elliott. Just kind of interesting here, just to see, are we at the end of an easing cycle? So if we're at the end of an easing cycle, not necessarily a very strong hiking cycle, but basically in the European money markets, in the US, easing cycles are being sort of priced out of the market. In some cases, like Australia or the UK, or the ECB for Europe, the actual sort of hikes are starting to be priced in by the end of 2026. And just to get a bit of perspective of this. This is looking at the major sort of global central banks. So this is rate hikes subtracting cuts. So basically saying, are we sort of on a sort of a hiking cycle or a sort of an easing cycle? And what you can see here is that, so this is agglomerated of the major central banks. You can see here that if you actually look at the period of high inflation after COVID, obviously it was a hiking cycle. And then basically we had sort of an easing cycle. But what we can see here, no pun intended, is that easing off. We can see here that we're getting back towards neutral. And could it be that we're going to start heading higher towards, if not even sort of, as I said, very, very strong hiking cycle, maybe, not really sort of any easing. And this is particularly important in the case of the Fed, because everyone was assuming that Kevin Walsh would come in, he'd be Trump's puppy or puppet, and he would automatically cut interest rates, 25, 50 basis points, 2 or 3 times this year. That was the discussion. Would it be 2 or 3 times this year? But that's not actually happening at all. And you can see, just got yesterday, this is just from the trading session yesterday, on the futures. And you can see here, this is from about 8 a.m. until 4 p.m. And you can just see that, for example, looking at the SOFR contracts here on the June 26, September 26, December 26, and then December 27, you can just see how each tick represents a basis point. So you can just see here over the, even just the course of one trading session yesterday, we had significant, for example, December 26, you had, what's that, about sort of 8 or 9 basis points of negative, or what do I say, negativity, hawkishness. So prices going down, and this is equates to an extra 8 or 9 basis points of sort of higher yields. And again, looking out to December 27, very, very, sort of hawkish repricing. And then if you look at the broader sort of bond tenors, again, this is from yesterday's trading session. I did a snapshot at about 4 p.m. compared to about 8 a.m. when I actually opened my trading here. And you can see here we've got the 2-year, the 5, the 10, the 30, and the ultra bond. So it's at the very front end. This is an incredible sort of a bear flattening here. You can see, just look at the ZT, which is the 2-year futures. You can just see how much they went. They grinded down all day, which happened to all the bonds. But you can see it at the long end. So the ZB, which is like the 15 to 20, and the ultra bond, which is truly like the 20-year plus, that was negatively impacted, but not quite as much. And really, what the market has moved aggressively to price in here is an aggressive a sort of understanding that this inflationary pressure coming from higher oil prices, but not only oil, but also like fertilizers, which is going to feed into food prices, and a general sort of dislocation is going to make it very, very difficult for the Fed to cut interest rates as the market had been pricing in. And just give you a sense of that, I mean, just take one example. It's not only crude oil. This is the Singapore contract for jet fuel. Just as an example, this is putting a lot of pressure on the sort of airfares and the costs of running sort of airlines. And you just look at this, just pre-Iran crisis, we were trading at about, I call it about 90 bucks or whatever, up to, has basically doubled. So that's just one market. And then, then the question is this going to sort of resolve anytime quickly? And just doing a bunch of research yesterday, and overnight, you can see here, this is just from Bloomberg. This is the amount of a sort of tankers crossing, and you can see in the Hormuz Strait again. This was a screenshot of yesterday morning, so technically not exactly what's happening right now, but within the last 24 hours, you can just see that the traffic passing through the Strait of Hormuz, which was at 60, 70 sort of ships per day, has essentially gone down to zero. Now the Iranians are saying that they're not actually blocking the Strait of Iran, but it's the potential there, and it's also the insurance. Essentially, it's almost impossible to get insurance, and so shipping companies have sort of de facto basically decided unilaterally not to pass through until the situation calms down. The other thing just to keep in mind is listening to a podcast yesterday. Interesting that there's all desalination plants all over the Gulf, not only in Iran, but also in Israel, in all of the Gulf states. And the point is that just keep in mind that, how can I put this? If the Iranians were to sink ships, you're talking some of these very large carriers with capacity of 1 or 2 million barrels of oil. Most of these desalination plants are actually on the Persian Gulf or on the Straits of Hormuz, just actually on the water. They risk essentially massive and catastrophic pollution, which would potentially put offline the desalination plants. And you suddenly have a situation where that whole Gulf area, not only Iran, but also potentially the Gulf states themselves, and who knows if Israel's desalination plants would be attacked, not having water. Okay, so we can talk about all of this stuff, but let's keep in mind that the massive escalation would be the desalination plants. And Iran is also very, very well aware that it's not in their interest, or also their Shiite kind of cousins, so to speak, in the neighboring Gulf states to sink tankers carrying 1 or 2 million barrels of oil. So I think really the issue here is kind of more a lack of insurance rather than the real threat that Iran will start blowing up tankers with 2 million barrels of oil, because that would destroy all of the desalination plants, which essentially would cause extraordinary sort of societal pressures of literally a whole geographic zone of the world without drinking water. That is a big problem. Anyway, just getting back to the sort of inflation issue. So again, a sort of a snap of the SOFR curve from yesterday afternoon about 2 p.m. So pretty much up to date. As a snap yesterday, as I say, about 2 p.m. You can see here just how hawkishly, as I was saying, that the SOFR curve has repriced. And again, I mentioned this yesterday, but let's keep an eye on this. You can see that for the contracts, for example, December 26, March 27. In the last, let's say, month or so, these things have repriced about 30 to 40 basis points. You can see down here. So that's really where the pain is being felt. And it's going to be, for me, incredibly interesting just to see what Walsh does. But keep in mind as well that increasingly the Fed is becoming less unanimous. If you actually look, there's more and more sort of dissents. And keep in mind that any sort of decision taken by the Fed requires a majority of 7. There are 12 voters, 7 for a majority. Walsh is 1, Stephen Miran is 2. Essentially, anything which Walsh wants to do, even if he wants to keep Trump happy and cut interest rates, remember that he will have to get on side another 6 members. And as far as I can see, looking of the 12 potential voters, like 8 or 9 of them or 10 of them over the last month have made relatively hawkish comments. It's going to be a very interesting dynamic, but that's probably for a few months down the track. So the point is that, when and how could the Fed cut? that would have to be probably a sort of almost like a catastrophic deterioration in US economic conditions and the labor market. And we know that the labor market at the moment, although the last non-farm payrolls was fairly negative, because that immigration, for example, is essentially at zero, the replacement, the sort of level of new jobs which need to be created, which historically, when I say historically, let's say the last 10, 15 years, was about 120, 150,000 new jobs per year to sort of cover all of the new immigrants and, new people coming to the workforce. If that number is now about zero, maybe the replacement number of necessary jobs to create each month is sort of, some people saying it's only, 5, 10, 15, 20,000, or maybe even sort of zero. So the point is here is that that's does the Fed need to cut if there aren't that many new jobs? It's not like the old days where we say, oh, we only created 20,000 new jobs. This is a problem the Fed needs to cut. Maybe the new normal is that if the US is creating, even zero or +5 or +10 or +15,000 jobs with zero net immigration, maybe that signals a labor market which is sort of okay. Anyway, point being that today we're going to get a bit more information. First of all, we're going to get some information about the core PCE. So we're going to get an update on the preferred gauge. But again, just keep an eye on the core PCE. I just pulled out the numbers here. The core PCE had been essentially, if you look at it, this is the year-over-year number. And, ostensibly the Fed's target is 2%. But really what we can actually see here that, for the last few months and even last month, the last readings, it's well above 2%. It's whichever way you cut the cookie, it's 2.7, 2.8, 2.93, et cetera, et cetera. So it's also expected to come in today. If we just look at what we're going to be getting, the core, the consensus is over 3%. So the previous 3% consensus is 3.1. We're getting very far away of the 2% inflation target at this point. It seems to be the new normal. And keep in mind, this is not including what's going on with the energy complex. So we can only sort of hold our nose and hold our breath and imagine what's going to happen in the next readings, the next month or two, where this should be substantially higher. And then if we look at the PCE core, where's the PCE core month over month? Let's see if I can find that. Why did they separate it? This is they also have 730. It's at 830, of course. Anyway, the core PCE price index expected to come in at 0.4. So again, if you start to annualize this stuff, you're well over sort of 3%. And this combined, everyone knows that the energy prices have gone up. So this is what's putting the bond market under a lot of pressure. We also get this morning, pretty interesting, we're going to get some durable goods data, which is a choppy number, but interesting. And then what's also going to get the market's attention at 10 a.m., not 9 a.m., is the JOLTS opening. So let's keep an eye. And really the narrative from the JOLTS over the last 2 or 3 months has been that not that many people have been fired, but not that many people have been hired. So it's sort of a market in equilibrium, a labor market in balance. But we have started to see more sort of signs of people being fired. So is the JOLTS number going to give us a bit more negativity? So where does that leave the markets? Really what we could say is, again, just looking at what's priced in here, just finally, if we look at, let's say, December, you can see here that the market is essentially saying that there's a pretty good chance of maybe no cuts at this point, a 42% chance of no cuts. And it looks as though, the market, there's also like a 40% chance of one cut. So as we all know, I won't belabor the point, but we've had a significant sort of sort of pricing in a hawkish way. As I say, basic tendencies here. I mean, what's going on here? We've got gold finding it difficult. Gold just is sort of trade. Gold is not collapsing. So let's not. I still believe that the macroeconomic conditions are still in favor for gold to actually have a run higher later in the year. But with very elevated. So the real yields are going up. US dollar very, very strong. Inflation strong. This is difficult for gold at the moment, especially with the strong real yields and the strong US dollar. But it's not really doing anything wrong. It's simply just sort of trading sideways. Similar kind of situation with here. Silver a little bit weaker. What is interesting is that BTC is showing constructive price action. I was saying a few days ago that this fib level couldn't really be broken. It did break a little bit, but the bulls have come back relatively well. So that's I'm going to call it constructive price action here. It's not yet an uptrend, but it is constructive. We definitely do seem to be carving out some kind of base in the crypto space. Although the next key level is going to be this level here at about let's call it about 74,000. Again, that's the big sort of fib 38% retracement, which is also that recent high. The bulls will have to take it there. If it stalls out there and fails and is substantially rejected, that is not good because really this is key. So this is really the key hurdle. But so far so good for the crypto space. The other big trends, of course, is the US dollar, which remains very, very strong over the last 24 hours. You can see here the dollar index had sort of taken a pause, but it's now up to this very key level, which you can see is like a triple, even a quadruple top, and essentially just over the 100. You see what a big level this is here. We know that the dollar index is about 58% euro, but the dollar, so you see the euro here is breaking down through key levels. You see here it broke the support at about 115. Retesting down to 114. So this continues to be under pressure. And of course, Europe is a major energy importer. We could see that the price of nat gas is higher in Europe. Obviously, gasoline, crude oil, all of these things are going much higher. And that's potentially weighing on growth. And we can also see over in Europe that the ECB, the market is pricing in the chance of hikes for the ECB. We can have a quick look at that. Maybe if I can just oops, that's not what I want. I want to be, sorry, a lot of stuff on my computer here. Let's just go over to the short-term interest rates. And you can see here that on the Euribors, if we go out to, let's say, December of 2026, you can just see, I mean, I've showed this chart before, but we're at about 2%. And remember, the ECB was in a happy place, you know, about a month ago, neither hikes nor cuts. But you can see here, as we speak, that's gone up to 2.5, so up about 50 basis points. Which implies that, you know, by the end of the year, there'll be two hikes, not cuts, not holds, hikes. And therefore, there's a worry that this increasing inflation will necessitate the ECB to hike. And that brings with it the concerns about sort of slowing growth. And that's why you're seeing things like the euro under pressure, same with the Japanese yen. Actually, just while we're here, let's also just look and just see what's happening in the implied yields here for the SOFRs. And what I think is interesting is that you can see the similar kind of situation, not quite as dramatic as Europe, but you can see since the crisis started that let's say the implied yield for the December SOFR in the US has also risen, you know, almost exactly 50 basis points. So taking out, you know, those cuts. So we're now in a situation where the market is almost saying that the Fed will not cut at all in 2026. And that's going to create a very interesting dynamic, especially with Walsh coming in and being pounded by Trump. Even Trump yesterday was talking about too late Powell wants him to be cutting interest rates, even with this high inflationary sort of energy shock. So I'm looking at this because I think this could start to be quite an interesting, you know, sort of a potential trade idea, and something which I am starting to sort of to look at is something like I'll just bring it up here. Sorry, stop share. Is something like a call spread here on the SOFRs. So you're looking at the December SOFR contract here, something like the 97 to the 98 call spread, something like that, 97 to 98 call spread, which is trading at the moment at about 10 ticks. So that's kind of an interesting one to be looking at, because if the Fed does come in and cut, if the economy does deteriorate, and the Fed and the jobs market collapses, you know, we can assume that there will be, you know, at least one cut. Who knows? But I just think that's an interesting, if you know, something like the call spread, as I said, the 97 to 98 December SOFR options there for trading at about 10 ticks. I think that's that's becoming quite an interesting risk reward proposition. Okay, but just getting back to a couple of other sort of markets here, the equities are trading okay. I mean, volatility obviously remains elevated. In the mid-20s, mid to high 20s, so volatility remains very elevated. But if we look at the ES futures here, I mean, they're up today 33 basis points, but they're trading heavy. I mean, it's been a long time since we tested the highs. Let's be honest, it's been, you know, a couple of weeks. Are they collapsing? No, but every day it feels like the weight of gravity is coming down. Similar kind of situation here for the Nasdaq. And if we just look at some of the subcomponents which have been in the news, if we look at the the software ETF, IGV, that's starting to roll over a little bit. If we look at the semiconductors, had a little bounce, but yesterday was a bit negative. If you look at the Mag 7s, the big mega caps trading heavy. So if we look at the equal weights, also trading heavily. So even the US equities, they're not collapsing, but it's like this pressure of the higher yields and the higher yields and the higher energy costs are starting to weigh. What we are also seeing another big trend is just the global equity is underperforming. So we can see here that the SPY underperformed a global equity, but so far, even though the US equities are trading on the heavy side, not nearly as badly as some of the rest of the world. And we can see here the Euro Stock 600 also under a lot of pressure. We see the DAX under pressure. We see the poster child, the Bovespa out of Brazil under a lot of pressure. We see in Japan the Nikkei and the poor old India, which of course is a massive energy importer, just being absolutely sort of shellacked the Sensex. Now compare India, for example, compared to the Bovespa over in Brazil. So Brazil is a major sort of commodity exporter. So although it's under pressure, it's performing a bit more like the US that's kind of like trading heavy. But compare that to, let's say, the Sensex, which is under a lot of pressure. China under pressure. You look at emerging markets, EEM also under a lot of pressure. So basically emerging markets, and that's because countries like South Africa and some of these countries which had been doing very well. The problem is with the very strong dollar, that is making the cost of repaying. It's putting inflation is up with the energy, and secondly, especially for the energy importers, this is putting massive inflationary pressure, which had thought to be under control. And secondly, with the very strong dollar, you're seeing the cost of repaying their loans in dollar-denominated bonds is sort of very problematic. And if we go to just a couple of those currencies, just to put, whoops, hold on, I don't want to actually change it. Let me, hold on, let me go to FX. And just to put that into perspective, if you look at something like, let's say, the Mexican peso, you can just see that had been one-way traffic in favor of the peso, but you can see that that's under pressure there. And then you look at the South African rand, you see again US dollar putting it under pressure, and even against the Brazilian real, not as bad. You see it's not as bad. And the Korean won, you can see the Korean won also under pressure. So basically, it's a question here. You need quite a lot of nuance that emerging markets are under pressure, but those who are commodity exporters are doing a lot better than the commodity importers and energy importers like South Africa and Korea, for example. And just while we're here, also looking at the USD, now if for the JPY pushing higher, almost getting up towards that 160, are we in intervention territory? Maybe, but it's going to be difficult with these sort of higher energy prices. Maybe the Bank of Japan and the Ministry of Finance wants to hold off a little bit. But it could be interesting if the US thinks that the US dollar is getting too strong at this point in creating problems. It could be interesting if we see a joint intervention, which would be much stronger if the US Treasury actually actively intervenes as well. Also, what's interesting for me is that the Australian dollar, which had been doing pretty well, remember it's a net energy exporter. Just the risk-off sentiment is starting to sort of attack that as well. So that's kind of an interesting one here, that the Aussie dollar is under pressure. As soon as this crisis resolves itself, I think the Aussie will explode a lot higher. But for the moment, we're not quite there. Okay, guys, so I'm going to leave it at that. I just wanted to show you that. And again, today, let's keep an eye on the yield. So we're getting a crazy flattener as the front end yields are ripping a lot higher. Let's see how the core PCE, if that comes in soft, will that give a little bit of relief for the front end yields? If it comes in higher, plus the knowledge that energy is not doing well. Sorry, energy is causing a huge amount of inflation. That is going to put even more pressure on the bonds. And just by talking about energy and the US dollar also doing well, just have a quick look at oil. Oil coming off a little bit overnight, but still at very elevated levels. And this is despite the 400 million barrels, which the G7 nations have been sort of authorized to release. But again, you've got to keep in mind that this is going to, we're talking 1 million or 2 or 3 million barrels coming to market every single day. This is something which takes weeks and weeks and weeks. And secondly, the oil production, which is not being allowed to flow out of the Gulf states, we're talking maybe minus 10 million. So even though yes, there's got to be an extra million or two barrels a day in the US, and the same for the rest of the developed market and Japan and whatnot, it's still not making up the shortfall. And every day we go on without free flowing oil is just cranking up the pressure more and more. And by the way, it's not as though if this war suddenly ends that everything will get back to normal. The research I'm reading is showing that for crude oil, we're talking several weeks to get back to full production and flow. And in terms of nat gas, you're talking multiple weeks, maybe even a month or two or three to get all the nat gas and LNG plants up running again. Up and running. There's the cliche I was looking for, up and running in places like Qatar. So the point is that we still have elevated WTI. We also have still very elevated Brent over $100. Gasoline prices are still very elevated. And over in Europe, the nat gas has come down a little bit, but still compared to pre-war is essentially almost doubled. So there's no respite for energy and therefore inflation and therefore hawkish repricing. Bond yields are up, dollar very strong, emerging markets under pressure, energy importers under pressure. All of these trades are still the same. Fertilizer prices are up. As I was showing yesterday, some of the fertilizers, just having a quick look at that, if we look at just some of these agricultural sort of chemical companies, you can see the moo. I think I showed this yesterday. The ETF, having a positive couple of days, pre-market up even higher. If you look at IPI, Intrepid Potash, I mean, this is all fertilizers, the squeeze. You see here, I was showing this yesterday, you see that these companies are pre-market ripping higher, Mosaic ripping higher, Nutrien. These are all companies heavily involved in the agricultural chemicals, fertilizers industries, and all going much higher because we all know that about 30% of fertilizers come out from the US. Okay, guys, I'll leave it there. As I say, let's keep an eye on core PCE, but also personal income and spending this morning. And then at 10 o'clock, we have the JOLTS number for further a clarity potentially on the US labor market. It's going to be interesting to see if that weakens at all, because that would start to cause a narrative of stagflation, higher inflation, but a weakening labor market and a weakening economy, which is not good and potentially not good for stocks at all. We'll keep an eye on that. Okay, have a great day. Have a great weekend. And I'll be back with more of this over the next few days. Thanks very much and take care.